All right, so good morning, class, and welcome to our lecture on IFRS 9, 32, and IFRS 7 together that makes up financial instruments. So we're going to look at financial instruments. All right, so like I said, financial instruments have three standards embodying it. So we have IAS 32, and IAS 32 talks about the classification and the presentation of financial instruments in the SOFP, because the position of the financial instrument in the SOFP matters a lot. So is it a financial asset? Is it a financial liability? Is it an equity instrument? So the position matters a lot. So we're going to go in and look at that, and that will be the basis for me introducing financial instrument to you. All right. Then we will also be looking at IFRS 9. IFRS 9 talks about the recognition and measurement of financial instruments. And we're going to, aside that, we are going to talk about the impairment of, because inside there is a financial asset there. So as part of the recognition, we will be talking about the impairment of fixed assets, a financial asset, because impairment of fixed asset is dealt with under IAS 36. So we're looking at impairment of financial assets. And we'll also be looking at derecognition. Derecognition. Notably, what we've been known to be called factoring. So with recourse and without recourse, those concepts are dealt with over there. Then later on, I will go on to show you how we deal with derivatives, okay? Derivatives, where we will be talking about hedge accounting. Hedge accounting. Then lastly, we will look at IFRS 7 that talks about disclosure of financial instruments. So you see, there's a lot to do in here. So let's just jump in and go into IAS 32 for the start. So we're looking at IAS 32. All right, that is talking about the presentation, what financial instrument is, and the classification and the presentation of it. So we're looking at presentation. So let's say classification and presentation of financial instruments. Looks as if this lecture is going to be in part, or it will be a very prolonged thing. So I'm going to do it in basically 3 parts. We're going to do the classification. We'll take financial asset, we take that in one part, we take financial liability in another part. Then we will take equity instrument and also the hedge concept also in another video. So it's going to be a 3-video part for financial instruments. So now, let's start with what financial instrument is all about according to IAS 32. All right, so financial instrument is a contract. All right, that gives one party a financial asset, and another party an equity instrument and or what, a financial liability. So this effect is coming from the old definition, and I really like teaching this because it takes us back to the olden days. Do you remember this? Assets is equal to what? Equity, when we used to call it capital, plus liability. You remember? Yes, the accounting equation. So basically, that is what this thing is about. So it's a contract. It will give one person a financial asset and another person an equity instrument and or what? A financial liability. So it kind of gives us the old accounting equation concept. And so you could see the classification right here. And so that leads us to we talking about the classification of financial instruments. So you could see there are three classification. Three classifications are just shown here. All right. So we're going to classify them. As you can see, we have three. We will then talk about, under these headings, we are going to talk about financial assets, we're going to talk about financial liabilities, and lastly, we'll be talking about the equity instrument. All right, so let's be quick on that. So this is basically our accounting equation. Now, what is a financial asset? A financial asset simply means cash. All right, it is cash. It is also an equity instrument. In another entity. And like I say, it can even be a debt instrument in another entity. Why? Because the word asset, you remember the definition of asset, economic resource controlled by an entity. All right. And that's the reason why they stick into this equity. We're talking about economic resource controlled by an entity because of past events. And in the olden days, before March 2018, we used to add, which will result in future economic benefit flowing to the entity. And that future economic benefit flowing to the entity has now become the recognition criteria, because definitely if you control something, the benefit will flow to you. All right, so that is that. So you have an equity instrument in another entity. Why? Because with an equity instrument in another entity, you stand a chance to control. You get the picture now. Yeah. So one could say owning a liability, but most of the time a liability is far-fetched for you to be able to have control over an entity. But equity instrument, you do. So that is why financial asset includes an equity instrument in another entity. Again, we talk about the right to receive cash. Right to receive cash. So this one should have ended with in another entity. Right to receive cash or another financial asset in another entity. And of course, my students will tell you that this statement you have made is simply saying a receivable. All right, that is that. And again, if you have the right to also exchange a financial instrument. So if you have the right to also exchange a financial instrument with another entity, and potentially favorable condition, then you also have a financial asset. Like you are taking something small for something big, something small for something big. So again, if you, let's say you have an you can exchange one financial instrument for another where you will benefit. It also deemed a financial asset. So under favorable or potentially favorable condition, because why? Economic benefit has been flown to you. All right. Then lastly, this is the part that makes it very interesting, and be careful about that. So we have the non-derivative, and a non-derivative example of a non-derivative is a share. All right. So we have a non-derivative contract which an entity may be obliged to receive variable number of its own equity instrument. Variable number of its own equity instrument. So basically that is that. In the same vein, when you talk about a financial liability, and please take note of these words, variable number. It's not fixed. Variable means that you don't really know the number. All right, you don't know the number of its own equity instrument or equity shares. Let me make it shares. All right. So that is that. Now we talk about financial liability, obligation. So obligation to deliver cash or another or a financial asset, not fixed asset too. FA here means financial asset, or financial asset to another entity. So here the key word is that you have an obligation coming from the fact that it is a liability. All right, so that is that. Again, if you have an obligation to exchange a financial instrument with another entity, so financial instrument with another entity, and a potentially unfavorable condition, that one to surmount to a financial liability. Then lastly, we have a non-derivative like shares, contracts, which an entity may be obliged to deliver. So here it was received, but here is to deliver variable number of its own equity shares. All right. So that is that variable number of its own equity shares. So here the word variable is the key. You have to be very, very careful. You'll be delivering some shares, but you don't really know the number of shares. It's variable. It depends on something. All right. So if it depends on something, then it means that it is a financial liability. But if it is fixed, then it means it is not a financial liability. Now, bear in mind, what we are doing is what? Financial asset is equal to. All right. So the issue is not about a financial asset. We don't have a problem with the financial asset. But sometimes how to break the tie in this side. Is it asset? Will it be financial asset is equal to liability, or it will be financial asset is equal to equity instrument, or equity instrument plus financial asset, financial liability? So there is a tiebreaker between the financial liability and the equity instrument. So you have to know the difference, and that is where in this case, you see over here you have an obligation. So it makes it easier. But here it's a non-derivative, and the key striking difference is the variable number. You don't know the number of shares. The number of shares will be dependent on something. Most of the time, the fair value. All right, so that is that. So that is a liability. If you remember when we were doing IFRS to share-based payment, you realize that when it comes to the cash settled share-based payment, we are going to depend the cash payment on what? The value of the share price at each reporting date. So remember, that was what? Liability. All right, so that is that. So this one, to the same vein, you don't really know the number. If you know the number, it will be equity instrument, but you don't know the number. So that is that. So equity instruments, don't forget, like the way we used to learn in senior high school, where we say that equity will be equal to asset minus liability, the change of subject. All right, of this, that is the same thing. So we say equity instrument is the residual interest. Residual interest, what you will get, all right, in an asset, in the asset after deducting all of the entity's liability. And this statement is something you need in consolidation, because those of you who further learn consolidation, you realize that there's a working tool that is done, fair value of the net asset. All right. So this is actually called the net asset. That is the meaning, the equity. Yeah, that is why your working tool embodies all those things in your equity. So this is just an eye opener. All right, so ladies and gentlemen, this is IAS 2, IAS 32, which calls on us to do this classification. Why is it important we do this classification? So for example, especially for the liability and the equity instrument, it is very, 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 very important. Why? Because if the thing is classified as a liability, it means that the company's gearing, the entity's gearing will go up because it is a liability, will go up. If it is classified as financial equity instrument, then what you see is that the company's gearing will go down. And again, the interest on the liability is treated as what? Finance cost in the P&L. So which means it will reduce what? The profit. So that is it. Interest reduces profit if it is classified as liability. But if it is classified as an equity instrument, the interest, or in this case, we may call it the dividend or whatever it is, interest or the return is treated against retained earnings. So you won't have any effect of it in the P&L. So it's very, very important you understand the classification. It's very, very important. All right. So that leads me to talking about the interest and the dividend concept. Of course, that is what I've already outlined here, all right, for you to see. So the interest, for example, we are looking at the interest treatment. So like I've said, the interest treatment follows the classification. It follows the classification. Interest treatment follows the classification. So you could see if it is classified under liability, interest reduces profit. It's called finance cost. And if it is treated as an equity instrument, the interest is actually called dividend. And it is treated against retained earnings. All right, so that is that. So while this one is affecting the profit or loss, this one is affecting the statement of changes in owner's equity. So that is that. So be careful. All right, so you could see clearly that, for example, the dividend is paid to two categories of people. Dividend is paid to the redeemable preference shares, because they own shares. And dividend is also paid to, may be paid to the irredeemable preference shares. It stands to fact that the dividend paid to the redeemable preference shares are treated as finance costs in the SPL because it's a liability. Redeemable, you have a liability. Irredeemable is called a dividend, and that one will be presented in your statement of changes in owner's equity. So it's treated just like ordinary shares. Treated like ordinary shares. And it will go to your statement of changes in owner's equity. So please, that is that. Lastly, you are allowed to do any offsetting. So offsetting is only allowed if it is legally enforceable for you to offset. All right. You have a legal enforceable right to offset. Not only that, also when the assets and liabilities occur simultaneously. So that one too, you can offset. All right. So this is IAS 32, the first part of our standard in financial instruments. So that is what you need to understand. Let's take an exercise. All right. So look at this. It says that Foster wishes to purchase a new ride for its Amazon animation animation Galaxy theme park, but requires extra funding. So on 30th September 2013, Foster issued the following preferences. All right. So that is that. And in all these things, we are required to actually discuss whether these financial instruments should be classified under equity instruments or financial liability. We have 5 marks. So let's look at them. So question 1A, 1 million preference share for each, 3 cedis each. No dividends are payable. Foster will redeem the preference share in 3 years' time. No dividends are payable means that it kind of seems is it redeemable? But no, it is redeemable in 3 years' time. All right. It is redeemable by issuing ordinary shares worth 3 million. The exact number of the ordinary share issuable will be based on their fair value at September 2016. Clear cut. We don't know the exact number, so it is variable. And if it is variable, we are delivering. And if in case it is variable, then it means it's a clear cut of what? A financial liability. All right. That is that. The second point is 2 million preference shares for 2.80 each. No dividends are payable. Preference share will be redeemed in 2 years, so it's redeemable by issuing 3 million ordinary shares. This one, we know the exact number of ordinary shares we are supposed to issue. So it's clear what it won't be a financial liability. And we have two choices. If it is not a financial liability, then it's clearly what? An equity instrument. So the word variable is brought to test. 4 million preference share for 2.5 each. They are not mandatorily redeemable. That means it is what? Irredeemable, right? A dividend is payable if and only if dividends are paid to ordinary shares. So it has classified the preference share as like an ordinary share. So that one too is clear, right? Your guess is as good as mine. We have equity instrument. So that is that. Easy peasy. We get our 5 marks. So we say it's financial liability because of the variability of the number of shares. Equity instrument because of the fixed nature and known number of shares. Then what? We also know that it's equity instrument, the third one, because there is no mandatory, it's not mandatorily redeemable. And again, dividend is only paid when ordinary shares are also receiving their dividend. So it puts you in an equity instrument situation. So ladies and gentlemen, this is IAS 32, which talks about the classification. All right, so that is that. Now let's move on to the second phase of what we want to do. That is IFRS 9. And this video, like I said, will finish the IFRS 9 in terms of financial asset. All right, so IFRS 9, recognition, and measurement of financial instruments. So we're going to pick them one by one. First of all, we want to start with the initial recognition. And here our focus, we are starting with the financial asset. In our next video, we will talk about financial liability. And in the last video, we will talk about how the equity instrument is done. So we look at financial assets. All right. So what is the initial measurement, or what is the recognition criteria for financial assets? Now, recognition criteria for financial assets according to IFRS 9 says that you recognize financial assets when and only when, all right, an entity, only when an entity becomes a party to the contractual provisions, all right, provisions of the financial instrument. So I always say that reporting is not accounting. Reporting has now become a law. All right. So this recognition criteria that you always have is always a law. And listen carefully. It didn't say when a party becomes, an entity becomes a party to a contract. It said when a party becomes a party to the contractual provision. So for example, if you take a trading commitment, in a trading commitment, the laws that are governing a trading commitment is IFRS 15. And IFRS 15 says that you become a party to the contractual provision when what? Performance obligation is satisfied. COPA, when performance obligation is satisfied. So you don't say that immediately you sign a trading contract, you have a revenue. No, you have revenue when the performance is satisfied. The performance obligation is satisfied. So you were supposed to deliver asset, you have delivered the asset. So if you fulfill the performance obligation, then you can now start recording what? Your revenue. So it depends. It's not like when you sign the contract, the construction contract, you have no. So even construction contract, we've learned here that revenue is what recognized over time. So when you finish the part you've done, you recognize revenue. So that is how it is. All right. Again, let's look at a forward contract. A forward contract. You know a forward contract. So these are derivatives. So forward contract is a derivative. So that one is slightly different from the way IFRS 15 deals with its revenue recognition. Because when it is a derivative, financial asset is recognized when at the commencement date. Commencement date. Not the date the transfer is done. Not the date, not date of transfer. That's a derivative. At the commencement date. Yeah, so if you say the thing will commence at a future date, then that is it. That is it. The same thing for an option. An option too is the same thing. Option is also a derivative. So that one is the date the contract is entered into. Is entered into. All right. So if it is a liability, because this one is an asset, let's say it's a liability, you have to start making a provision for the liability. Do you remember IFRS 2? Yeah, grant date, vesting date, exercise date. So you don't wait to the exercise date. All right. So that is commencement date, not when the exercise is done. So not when asset is delivered. Not when asset is delivered or is transferred. So please be careful about that. You start recognizing the thing even prior to that. So it's when the contract is entered into. All right. So that is that. All right. Not when the option is exercised. No. So these are the recognition criteria for a financial asset. What about the measurement? That is where the big issue is. So let's talk about measurement. So every measurement, we have the initial measurement and we have the subsequent measurement. So let's talk about initial measurement. Now here you have to be careful because the initial measurement of a financial asset is based on whether the financial asset is a debt instrument or a non-debt instrument. So you have to find out, is it a debt instrument or is a non-debt instrument? Please find out. Find out. Because there are two ways you can, you see, when we learned the equation, it was what? Financial asset is equal to what? Financial liability plus what? Equity instrument. So which one of this is doing the equation? Is it financial asset is equal to financial liability? In mathematics, if you say something is equal to something, then it is the same. So is it that it is a financial asset which is via a financial liability, or is a financial asset which is via an equity instrument? So which one is which? So that is why you need to know which form of financial asset it is. Is it a debt instrument or is it a non-debt instrument? Now, if it is a debt instrument, we look at three initial measurements. We have the amortized cost, We have the fair value through OCI, that is fair value through other comprehensive income, and we have fair value through P&L. All right, we will explain this. Then here too, we just have fair value through OCI, and we have fair value through P&L. All right, so that is that. All right, so it's very important you distinguish between the two because, for example, the initial measurement for these two is different from the initial measurement for this particular one. So if the thing is at amortized cost or fair value through OCI, all right, the initial measurement will be the fair value or the purchase consideration of the financial asset plus transaction costs. Transaction cost. Please, what is transaction cost? Transaction cost is any cost you incur in getting the financial asset. So it can be an issue cost, it can be broker, you pay, all those things. So please, they are all transaction costs. So you add it if it is at amortized cost and if it is at fair value through OCI. But when it is fair value through P&L, the initial measurement is only the fair value. You don't add the transaction cost. In this case, the transaction cost is treated as what? An expense in the SPL, in the XPL. So you have to be very, very careful. Find out which one is it. Is it amortized cost or is it fair value through OCI or is it fair value through P&L? For all the fair value through OCI, that one, it is easy. You have to add the issue cost, which is the transaction cost, all right, to the financial assets. Is that okay? So if it is fair value through P&L, that one, please, I didn't say subtract the transaction cost from the fair value. No, I said don't add it. Don't add it. All right. Treat it as what? An expense in the P&L. So in fair value through P&L, all you need is the fair value or the purchase consideration. All right. Transaction costs are treated in the P&L. All right. So take note of that. Take note of that. All right. So what did I say? If it is fair value, it is amortized cost or fair value through OCI. The initial measurement is what? The fair value plus transaction cost. If it is fair value through P&L, it is what? Only the fair value with transaction cost treated as in the what? SPL, all right, as expense. All right. So please take note of that. All right. So that is that. But how will you know this is amortized cost? How will you know this is fair value through OCI? How will you know this is fair value through P&L? So let me help you identify it, because we will use that also for our subsequent measurements. So how will you know? So let me just head in this for you, the amortized cost. Then we have fair value through what? OCI. And we have fair value through P&L. All right. When will you know this is an amortized cost concept? All right. So for the amortized cost, it means the thing must pass two tests. Two tests. The first test is called the business model test. Business model test, which I call the BM test. The second test is the contractual cash flow characteristics test. Cash flow characteristics test. And interestingly, these are the same test that is also under the fair value through OCI. So that one, you have the business model test, and you also have the cash flow contractual cash flow characteristics. So the same test. All right. So for the two, that is it. As for fair value through P&L, there aren't any test. All right. So what is this test talking about? This test is saying that the entity has no plan. All right. They have no plan of selling the financial assets. Okay. So they have no plan of selling the asset. All right. Prior to its maturity or before its maturity. They have no plans of that. And therefore, they will hold it. They will hold the asset till maturity. It's like you going to buy a treasury bill and saying you want to hold it to maturity. It is then that you can say that you have an asset and you are using the amortized cost for that. All right. But interestingly, this one too, the entity holds it to maturity, but they don't have a plan to sell it, or so this one says they have entity has no plans, no plans of selling the asset. But this one, they won't tell you the entity has no plan of selling the asset. All that it is saying is that the entity is holding it to maturity. To maturity. But they have plans of actually selling it prior to its maturity. What is the plan? You see, this one, they have no plan. So actually, the only reason why this thing under the amortized cost it will be sold is because they have cash flow problems. They have cash flow problem. And when they sell it, they are going to use the cash in their office. So that is that. They needed cash. So because they need cash, that is the only reason. So that is the caveat. The only reason for selling. If they will sell, then the only reason for selling is because they have cash flow problem. So if they sell, the proceeds that they get is not going anywhere. It is staying in the entity. All right. So that is that. But for this one, they intend to hold it to maturity, but they have plans of selling it. They have plans of selling it. And under what circumstances are they going to sell it? They will sell it if another opportunity, another investment with higher return shows up in the market. With higher return shows up in the market. If another investment with higher return shows up in the market. It's like a lady who is with a guy and thinks that another guy has popped up in the market who has more cash than the present guy he is with. So she runs to that other guy. Okay. But there are other ladies who say that we'll stay together unless the guy says he's leaving me. That is the amortized cost. Or it's like a guy who is saying that I have a beautiful lady, I will be with the beautiful lady till the end. And the only way he will let the beautiful lady go is when the beautiful lady says she can't do it anymore. So he'll be a gentleman, you let her go. All right. Somebody say, fight for her, fight for her. Really? All right. So in the other way around, the guy will see another beautiful lady and therefore dump the first beautiful lady. So that is how it is. So that is how fair value through OCI and the amortized cost concept work. You see, interestingly, their cash flow characteristics tests are the same. What are their cash flow characteristics? Here, the cash flows are that you will need the principal payment. You collect it back. It's like your treasury shares, you collect your principal back. But good news is that the principal can be redeemed at a premium still, which means they will give you something extra on top, or at a discount, which means it can be reduced. All right. The principal, this is the redemption. I never said this is for the redemption. I never said for the initial measurement. It's for the redemption. The second cash flow is the interest that you'll be getting. So the interest on the principal. The interest on the principal that you'll be getting. So these are the cash flows. 1, 2. Interestingly, it's the same here. So you have your principal, which can be at discount. All right. And you also have your interest. So principal is also called nominal. So it's the same thing. All right. Or coupon. So if you see all these things, it's the same. And the interest on the principal. So that is that. That is that. All right. So be careful of those ones. With these two, just be careful. With these two cash flow characteristics test. Be careful of convertible assets. Because convertibles, the cash flows are not the principal and the interest. The cash flows include cash and what? Shares. So they are never, if you see a convertible, it is not amortized cost nor fair value through OCI. So be careful. It is not. It is not. In that case, it means that it will be probably the third one, which is what? Fair value through P&L. Because IFRS 9 says that fair value through P&L is for financial assets, not classified or not recognized under. So it says that it is financial assets that are not amortized costs nor fair value through OCI. So if it is not amortized cost, if it is not fair value through OCI, then it means that it is what? Fair value through P&L. Let me give you a 2 clue. So in your exam, if you see that the financial asset is tradable or short term or even medium term, right there, you should know that it is classified under fair value through P&L. So these are your clues. So therefore, the subsequent measurement under the amortized cost, the subsequent measurement. So let's learn subsequent measurement. Under the amortized cost, subsequent measurement, you will do the amortized cost table. How do you do the amortized cost table? It's very, very simple. You will need your, like the way we did leases, all right? The arrears and advance. Here is most of the time in arrears. So you will need your year. So you write the year. Then you will need your balance brought down. What is the balance brought down? The initial measurement. Okay. So be careful. Be careful of your initial measurement. Here is amortized cost. So the initial measurement is what? Yes, fair value plus transaction cost. So don't forget that. All right. Then you will need your interest income. Interest income. So you need your interest income. So here, what is the interest income? Initial measurement, you have it. Interest income, you use the effective rate. Effective rate. So the effective rate multiplied by the initial measurement. So you multiply it here, then you get the figure here. So that is how you get your interest income. It's an income, so it is going to your finance gain. All right. So that is that. Then your regular receipts. If you have received money, you deduct. The regular receipt is always the percentage on the coupon. So the coupon percent on the nominal. All right. So the coupon percent on the nominal. So if it is paid, you deduct. If it is not paid, you still deduct, but you call it what? So if you have not received it, you deduct. If you are yet to receive it, it is a receivable. Please take note of that. Because some instruments will say they will receive everything all together on the redemption date, including this. So please, that one, it means that it is what? A receivable. If it has already been received, it's a cash flow item. All right, it's going to your cash. If it has not been received, then it is what? It is a receivable. Then the last thing is your balance carry down. All right, the balance that you are taking to your NCA. All right, so that is that. So it is this plus, oh, sorry, it is this figure you get here plus this minus this. This one is a year, so it's not part. All right, so that is how you do it. It's as simple as that. What if it is an amortized, it is fair value through OCI? And bear in mind, the balance carried down here will be the balance brought down here in the next year. So you continue the same process. All right. So when it is amortized cost, that one too, don't forget, is the same thing. It is for the fair value plus the transaction cost, which will be your balance brought down. So the year, all right, balance brought down. The same thing, the interest income, you calculate it on this. If it is received, cash. If it is not received, receivable, then you get your balance carried down. Somebody will say, but this thing is the same thing you have done. Yes, it's true. It's just that when it is fair value through OCI, the question will give you the closing fair value. So it will give you fair value. So you bring the fair value here. Then you now compare this, your closing figure, to this fair value. The difference is going to OCI. All right. So here, this thing is going to your SPL. This one is going to your NCA. All right. So the same thing, SPL. But be careful. This is the final figure that is going to your NCA. Or you can bring this one to your NCA and add the difference to it so that you still get this. All right. So in the second year, the question is, okay, so which of these will be the balance brought down for the next year? Which of these? Yes, it will be the fair value one. To be the fair value one. However, listen, however, the interest income, and this is why I am very keen on doing this video. However, the interest income will be calculated on the balance brought down of this. So the interest income for the second year will be the effective rate all right, multiply on the balance carried down, not the fair value. Not the fair value that you brought down here. No, it will be the balance carried down that should have come here. So when you are punching it, that is it. So you now take off this side and you end up with another balance carried down. Then the fair value that is given to you again, that difference is still going to OCI. So bring the fair value here, but when you are computing the interest income is not done on fair value. All right, on the fair value here. No, please. It's not done on the subsequent fair value. Let me say it like that, because here too, it was on the fair value, but it was just the initial fair value. So please, subsequently, don't do it on the fair value here. Do it on the balance the balance carried down, which should have been the balance brought down. All right, so it goes on and on like that. All right, thank you very much. What about if it is fair value through P&L? For fair value through P&L, there is nothing you do. All you need is the fair value, the initial measurement fair value. All you need is that one. Then the fair value that the question has given you at the closing. So the closing fair value at reporting date. At reporting date. So any difference between these two is going to the SPL. All right. So that is that, whether loss or gain. All right. It is called gain or loss on revaluation. And it is going to the SPL. So just like you learned in IAS 40, the same thing. And here too, just like you learned in IAS 16, a balance carried down or carrying amount and a fair value is going to the OCI. So it's the same thing, all right? So basically that is that. So let's pick up some questions and try and do that. Let's pick up some questions on that. All right. So what are some of the questions we can do? Let's go into your past questions. Yeah, these are the past questions area. I see this question 23. Let's see. It says that during the year ended 2018, Paki invested a convertible bond. So he invested in a convertible bond, which means he has a financial asset he invested in. So he will be having the right to receive, all right, on a convertible bond. On its issue date, the bond matures in 4 years after the issue date and can be converted into ordinary shares. And the entity plans to hold the bond to maturity to collect the cash flows. Advise Paki of the accounting treatment of the above transaction under IFRS 9 financial instrument. All right, so this one, be careful, because even though the entity plans to hold the thing to maturity and collect the cash flow, it's a convertible. And I told you that those ones that are financial instruments through OCI and amortized cost, not only is the business model test the one we use, but also the cash flow characteristics test. And so because this thing is convertible, the cash flows are not just mere the principal and the interest. So it means that, and it is a corporate reporting question, SVR. So it means that, ladies and gentlemen, with this question 23, it is going to be fair value what? Through P&L. So that is the accounting treatment. So you will say that even though the entity wants to hold it to maturity and collect the cash flow, it is a convertible. The cash flow characteristic test comes in the fact that they can convert it to ordinary shares. So it is the redemption. It is what shares and what liability. An asset of cash. So please, this one is fair value through what? P&L. So be very, very careful about these things. Very, very, very careful. The examiner is tricky. Be very, very, very careful. It's very, very tricky. And these are things that will get people, because the way they said hold to maturity, some people will be doing amortized cost, some too will be doing fair value through OCI. But please, cash flow characteristics test is wrong. All right, so please be careful. Let's go and pick some other questions. Let's go back. Let's use some other questions. There is a question I always use as my test question. That should be question 2, yeah. So this one, you have Paloma. All right, it says that Paloma has a new financial asset. The asset is a bond. So first thing I told you, you have to know whether it is a financial asset via a debt instrument or financial asset via an equity instrument. So right now, you know. All right, so now that you know, yes, so what will it be? Matures in 3 years' time. Paloma buys the debt instrument with the intention of holding it to maturity, although has on occasion sold the investment if cash flow deteriorated beyond acceptable levels. The bond pays a market interest. The finance director is unsure whether to use amortized cost. Yes, he can use amortized cost, because even though he's holding it to maturity, his selling is because of what their cash flow deterioration. It's not like they've seen another guy in the market they are going for. They've seen another investment in the market they are actually going for. So that one, yes. Question 2, you can use amortized cost. All right. Let's go on. Question 3. Yeah, I like this question 3 because it communicates everything. So this one says on July 2011, Tokyo bought 100,000 5% bond for 95,000. So fair value, the fair value is what? 95,000. Incurring issue cost of what? 2,000. Interest received in arrears, bond will be redeemed at a premium. Okay, that's fair. 5960 over the nominal. Okay, then you have 31st December 2013. The effective rate is 8%. The fair values for the bond for 2011 and 2012 is this. You are required to explain with calculation how the bond will be accounted for if Tokyo business model is to hold the bond until maturity. Which one is that? Amortized, right? But hold on. B is saying that to hold to maturity, but also will sell them if investments with higher returns or post up. So this one will rather be the fair value through what? OCI. Then Tokyo business model is to trade the bond in a short term. If it is medium term, to the same thing. So therefore, they traded it at 1st January 2011. They didn't wait even till maturity. So this one will be what? Fair value what? Through P&L. It's as simple as that. How do we solve this? So let's look at our question 3A. How do we solve this? Okay, we know that the A is amortized cost. And so our initial measurement will be what? The fair value plus issue cost. So fair value is what? 95,000. So before you write these figures, you might have explained it, all right? Okay, so fair value, we use this, then you use according to IFRS 9. So that is that. So the transaction cost is what? 2,000. And so our initial measurement is 97,000. So subsequent measurement, yeah, I think my machine is heated up. And so the pen is delaying in writing. So our subsequent measurement, the subsequent measurement, how will it be? So we have 2011. This thing started in January. So 2011, and we will have 2012. It will be redeemed in 2013. All right. So we are supposed to do this for the relevant years, right? So balance brought down, yes, 97,000. Finance interest income, so don't forget this. Finance gain or interest income, whichever one you call it, and the receipt. Please, the receipt, if they received it, the question says they received it, it is what? A cash flow. If the question says it is not received, then that money will be what? A receivable. Please take note of that. All right. So what is the effective rate? Yes, 8%. So we will do 0.08 by 97,000. That gives me 7760. All right. The receipt is always the coupon rate, which is 5%. Coupon rate multiplied by the coupon amount, which is 100,000, the nominal. So it means that it is what? 5,000 per annum. That is the interest. All right. So if I do minus 5,000 and I add it to the 97,000, I have 99,760. All right. This is amortized cost. So balance 99,760. I go again. Multiply by 0.08 gives me 7821 rounded. So 5,000. So plus 99. So I have 99,760 minus 5,000 plus 7821. That gives me 102,581. So my balance here will be 102,581. Then I do 0.08 on that. I have, so let me punch it again. This one was 97,760, right? Plus 78. Was it 78? So 0.08 multiplied by 99,760. Oh, it's rather, oh, come on. This thing is wrong. So it is rather 7981. Yeah, so that is what I have here. So what happened? All right, so if I had that 7981 plus 99,760, that gives me 107,741 minus my 5,000. So it means that this place is actually, so let me rewrite. Right. So we save the cancellations. So this one was 7981. 7981. Take off my 5,000. So what do I have? So it is 102,741. 741. So my balance is 102,741. If I do 102,741 by 0.08, what do I have? I have 8219 here. It is rounded. So I'll pay the interest on the final year. I'll pay my redemption, which is the 100,000, and the premium on top of it, which is 95960. So it means at the end of the day, this side should be 0. I think that's correct. Because if you add this to 102,741, you get the same thing. All right. So that is that. It means here is 0. So you are done. What about the amortized cost, the B? So the B is the same thing, don't forget. So here it will be 2011, we have 2012, and we have 2013. All right, so the balance brought down is 97,000, just like this one. 7760, just like this one. 5,000. Then we have 99,760. But it gave you a fair value of 110. So at the end of the year. So that is where the fair value model comes in. So the fair value here is 110. All right. So the difference between this and this is how much? That will be going to the OCI. So 110, 1, 2, 3, minus 99,760. That gives me 10,240. So ladies and gentlemen, this one will go to OCI. So here, the ones that we had, these ones were going to the SPL, then these ones were going to our NCA. So at the end of this year, what will go to your NCA is this one. This is going to your SPL, and this is going to the OCI. So please be mindful of that, okay? Be very, very mindful of that. So that is something you have to take note of. Very, very careful. But I told you that which one will be your balance brought down? 110, right, for the next year. I told you that it will be the 110. But which one will you calculate the interest income on? Yes, I told you that it won't be this. It will be what? This one. So it means the interest incomes will be the same. The same. So 7 is the same as you had here. 7,981. So the third year too will be what? 8,219. Nothing changes. Here will be 5,000. Here 5,000. Which means this side will also be 102. Oh no, it won't be because a little change happened in the opening balance. This one. So it means you have 110 plus 7,981 minus 5,000. So it means we have what? 112,981. And we were giving fair value of 104,000 at the end of the year. So with that in place, if I do minus 104, 1, 2, 3, I have a loss. A loss of how much? 8,981. So that is what I have. And here too will be 104,000. So the 104,000, I have 104,000. The interest income was the same as the old one, not on this. All right, be careful about that. So you have 8,219 minus 5,000. That gives me 10. So be careful. Here too, we have to deduct our 100. And also the premium of, yeah, so minus 105,960. That gives me 1,259. Fair value is 0. Therefore, there is an extra loss of what? 1,259. You add this to this, you realize that you are getting this. All right. So basically, that is what it is. So that is how fair value through OCI is done. But good news for you is that hardly would the examiner tell you to do for all the years. We only do for 1 year. All right. So that is that. So please be careful. All right. What about the C part? The C part, we are told that it is fair value through P&L. So that one, our initial measurement will be how much? Just the 95,000. We will treat the transaction cost of 2,000 to what? To P&L. So that is that. Then subsequently, we knew that at the beginning it was 95,000. It is tradable. And they said that, so in 2011, 110 here. So you know that the 15,000 is going to SPL. That's all. In the subsequent year, you realize that they actually sold it for the fair value. So they sold it at the fair value. So if they sold it at the 110, they will receive the 110 into cash. All right. But bear in mind, when it is fair value through OCI, then you have these OCI figures. Just as we do in PP, whenever the asset is finally sold, all those figures that are in the OCI now will be transferred to where? The P&L. So that at that point, it becomes what? Realized. All right. So that is that. You transfer the OCI balances back to the P&L. All right. So ladies and gentlemen, this is how you do it in the 3 stage. Let's solve some additional questions. Let's solve some additional questions. All right. So let's look at the past question. Let's go into and do some past questions. And watch, always be mindful of the examiner's trick. I think I have some past questions here. So let's start with the past questions. These are the past questions. All right. So this one is an issue. No, we've not done liability. So let's skip that. Let's look at this one. Baweleshi controls a financial asset. Okay, so we have this one as a financial asset. All right. So these are the days. It says that an investment in equity shares of Obojo Limited purchased in April 2016. What is the financial year end date? 31st December. So April 2016 to 31st December. Because this would have been nice if the thing was on 1st February 2016. So this is it. So this and this will give us 1 year. But this is April. So April will be how many months? 10 months. Yeah. So you have 10 months. April is 10 months. So please be careful. All right. Okay. So now what do you see? What you see here is what? They bought it for 2.6. And the fair value as at the end is 2.8. So that tells you that there is a fair value increase of what? 2 million. This is not an interest, it's a fair value increase. So you don't prorate fair value increase. So it means the initial measurement is 2.6 million and subsequently you have 2. Which model is that? Through OCI. Okay, so you say Ogbojo bought equity shares. You know, the equity side, we have only fair value through OCI and fair value through P&L. So those are the two we have. And here is they said that the fair value has jumped to this 2.8. But unless she has decided at the purchase date that they will recognize fair value. So as good as this, your difference is 0.2 million. And it says that they've decided that this one is fair value through OCI. So difference is going to fair value OCI. It's as simple as ABC. That's why it's a FR question. So just to give you some stats. All right. So that is that. That is that. But one thing that you should be mindful of in these things is that in the question, they should tell you the redemption date. So if the redemption date is 31st December, January, then fine. Then this is that they've held it to the redemption date. But if the redemption date was something different from this January, and they still say it is OCI, it won't be OCI because they made it a short term. Short term means what? Kind of something from now to 12 months or sometimes a little after. So even though it is like that, so you have to explain to the examiner that assuming the maturity date is also this date, then it means that this one will also go to OCI. But even if the maturity date was something in future, let's say 2020, and they said it is fair value, it's still short term. So you will say you're supposed to go to the P&L. All right. So be careful of that. So that is that. So this one is cool. An investment bond is issued by Shiashi on 1st February 2016. The bond costs 10 million and you have 8% interest per annum. All right. Per annum on the bond's anniversary. When is the bond's anniversary? Okay, so it is what, 2021. You see, this one is like how many years? 2017, 18, 19, 20, 21. This is like 5 years. its intention is to retain the bond to collect the contracted cash flow. So that is that, to retain the bond to collect the contractual cash flow. So what does that tell you? Yes, amortized cost. So that is that. So if that is the case, what do you do? What do? You do the amortized cost table. So initial measurement is the 10 million. So 10 million, amortized cost table, 8%, right? So the 8% on the 10 million is how much? 0.08. So that one will be, I think, the same 0.08. All right. Then actually, we don't have the coupon. So this is the Baulesch's, it says it's entitled to 8% per annum on its anniversary. 8% per annum, right? So there is a receivable of that. So you see that the 8% that you've calculated is an interest income that you should be getting, because the question says that and entitles Baulesch to 8% interest per annum. So that is what he's supposed to be receiving per annum. All right. So the principal, and they said that it is the intention to retain. So that is that. But here it says that 8% per annum on the anniversary of the bond. So it means that every year on the anniversary, every year, annum, that is what he will be taking. So that is that. So it means that the 8%, you will be collecting the 8% on this as money. But if it is not paid, I told you that it is what? A receivable. So this thing is the finance cost. We are not told whether they received. So since they've not received, or so if the question, per this question, if they've not received, you say you have a receivable of 8 million too. All right. So basically that is that. Then at the end of the day, so you have the balance. So assuming coupon rate is also 8%, then you do 0.8 and so on. But the most important thing here for you to cash out is the fact that there is they've not actually even given you the effective rate. So this one is the coupon rate per annum. So it means that they will be receiving 8 million. They've not give, so probably if the coupon rate is 0, if you take this as effective rate, if coupon rate is 0, it is 0. But this one said interest per annum on anniversary. So that is the normal coupon that they take. So the coupon, so that is what? The 8 million. All right. So we are actually not giving the effective rate. So this is the only thing you talk about, that this is a receivable interest. So let's say interest receivable. So that is that. Interest receivable or received. So this is going to your SPL. Basically, that is that. All right. You are not giving the effective rate for you to even be able to calculate the finance cost aspect. So you are just giving the 8% as the coupon rate. Calculate your coupon, get your amount, and go. All right. So that is that. Let's look at the next question. It's preparing financial statement, entered into a contractual in 2018 with another company. Okay, this one too, it's not a finance asset issue. Let's go to the next one. Asamanke say purchased, so financial asset. All right, so they purchased a financial asset. Is how much? 50 million. So you have 50 million, the fair value. Is it 50 million? 6%, 50 million. So 50 million is the nominal on August at a discount of 10%. Okay, so this is the nominal. They bought it at a discount of 10%. So it means the fair value was given. So you do 10% discount. 10% discount, it will be what? 5 million. So you see how examiners can be tricky. So this becomes the fair value. Be very, very careful. He bought it at a discount. So instead of giving you 45 direct, you see the way they phrased it. On the acquisition date, so this is not a discount at redemption. All right. So they said expenses of purchase were 5. Okay, so they also incurred another 500,000, which is 0.5 million. So that is the transaction cost. But will this transaction cost be added or be treated in the SPL? It depends on the bond nature. Let's go ahead and read. The bond is is due for redemption on 2028 at par. So you see, you cannot go and do the discount on the redemption. The redemption is already at par. All right. The effective rate is 7.3. Okay. Samankesi intends to hold the bond to maturity. Okay, so that makes it an amortized cost concept. So here we can add, right? So it will be 45.5. So that is our initial measurement. Since it's an amortized cost, we are holding it to maturity. What if they give you fair value and they give you this intent? It means that you are going to apply what fair value through OCI, because in both cases it is held to maturity. It's just circumstances of withdrawal or selling. So this one, at the end of the 31st July, we will have our balance brought down 45.5 million. Interest income, finance gain, what will it be? 7%, 7.3%. So 45.5 multiplied by 0.037. That gives me 3.3215. All right, or 32. Then my balance carried down will be minus 45.5. What I have here is 42.1785. All right, that's all. I'm done. Like I told you, the questions will always make it 1 year. And this is FR. You do this short thing, you are doing it for 5%. So be very, very careful. Be very, very, very careful. All right. So that is that. I am having this question. I tip it for the let's say March 2024. So let me write it down. All right. Okay, so that is that. Let's look more into corporate reporting question. This one is what they provide loans. So let's see. Is it a financial asset question? Let's see. Abiba Limited is a company operating in Northern Ghana and provides loans to customers and fund the loans by selling bond in the market. Okay, so they sell. If you sell, then it means it's a financial liability. So let's not go there. We've not done that yet. What about this one? Dan K bought. Okay, so bought 10. Okay, on August 2016 at a cost of 45 million. The bond carries a coupon of 5 million paid annually in arrears, an effective yield of what, 12%. So that's the effective rate on that date. Dan K is holding the bond as a speculative investment, expecting its value to increase, hopes to sell the bond in a short to medium term. Oyiwa. It's interesting. On 31st July reporting that the fair value had declined to 43. So you see, what do you think? Which one do you think this is? Holding the bond as a speculative, expecting to sell it to get profit in short term. It is tradable short term. So this one will be fair value through P&L. And that is simple. At the beginning, it was what, 45 million. At the end, it's 43 million. So all that you do is do what, 2 million to the P&L. Somebody will ask, so what happened to the effective rate? Yes, of course, the effective rate that you have here on this 45,000, 45 million is something that will be also be received. All right. So this one, we are talking about the valuation. So you can do the 12% multiplied by the 45. So that one is not a fair value. It's just your normal interest that you are supposed to be collecting. So 0.12 multiplied by 45, it means you are supposed to be collecting 5.4 every year. But they said that they paid 5 million. So it means that there is a 0.4 that is a receivable extra. All right, you need to collect that one. Then, so this one is a receivable. Then your 2 million is fair value change. So even though it is tradable, it doesn't mean don't calculate it. It doesn't mean don't calculate it. Calculate the 12% on the amount that they are supposed to be receiving effectively, but they've received only 5 million. So the 0.4 is a receivable. All right, it's an interest income receivable. All right, so that is that. So that one is like a current asset on your behalf. So ladies and gentlemen, this is it. This is where I would wish to end the class here. Then the next video will carry on with impairment of fixed assets, derecognition of fixed assets. Then we will add, let me just add it up. Let me add it up. Even though it will elongate the video, let me add it up. Because they are all under fixed assets, so that I know that I've dealt with the fixed financial assets, so that I know I've finished everything with financial assets. So let's talk about impairment of financial assets. Even my pen is tired. So I'm going to make it very quick. Please, what you have to understand is that impairment of financial assets only happens to those ones that are treated using fair value through OCI. Oh, my pen. The pen is tired and my machine is very hot. It's asking me to actually break. So let me pause a little. So these ones, like I said, are for those ones applicable to those financial assets that are under fair value through OCI and the amortized cost. So it doesn't cover those ones that are tradable, because you even wait for it to be tradable before you trade it. So basically that is the reason. All right. So now, what do you need to know under this one? What you have to know is that you need to calculate loss allowance. Please, in those days where you were in undergrad, or let's say senior high school, do you remember something we used to call provision for bad debt? Yeah. So it was done on what? Receivables, right? Good. The same thing we are doing is the same thing. You see, in those days, we were told that provision for bad debt is 2% on this. How did they come about the 2%? So here we are just learning the correct things. All right. So that is that. And so loss allowance is on financial assets. I hope you know that receivable is a financial asset because you have a right to receive something. So don't be confused at all. That is it. So what we are trying to do is to do the loss allowance, which in those days we call it provision for bad debt. So that is what we are doing. That is what we are doing. All right. That is the effect, like those days. So what do we need to do? We need to assess the receivable to see if we will lose something out of it. How will we know we will lose something? We will lose something if there is credit risk. So that is that. So if there is credit risk, or so we say if credit risk has increased, have we increased our credit risk? That is the question we need to ask ourselves. So the clue here is that if credit risk has not increased significantly, it has increased though. So that is it. But the increase is not what? significant. So if credit risk has increased insignificantly or not, the increase is not significantly. So the question is, has credit risk increased? That is it, because the only way you say there is a possibility of bad debt happening is when credit risk has increased. So that is the only way you can conclude that. But if credit risk has not increased, you can't say there is the likelihood of bad debt. You can't say that. You can't do that. So has credit risk increased? We will look at situations of credit risk increase. How will you know credit risk is increasing? Or how will you know the receivable is credit impaired? These are the signs. We all know that if debts are more than 30 days overdue, debts are more than 30 days overdue, then it means that there is a credit risk increasing. All right. It means the thing is credit impaired. Okay. Again, we all know that if your customer has gone bankrupt, so bankruptcy of client tells you that there is a possibility that you will not get your money. All right. If there is a breach of contract, then it means that there is coming to be a problem. So you will see some of these things in the question. The moment you see these things, it means that credit risk has happened. So it means that there is what we call credit impaired. It means your credit, which is your receivable, is impaired. Immediately you see these things, it means your credit is impaired. Now, if the credit risk, therefore, so you could see that they downgraded somebody from AAA to AA, those credit risk things. They downgraded, like, for example, in Ghana, as we are, they've downgraded us. So it means that our credit risk has increased. All right, so that is that. So the question is that, has it increased significantly or it hasn't increased significantly? So if it hasn't increased, so if the increase is insignificant, or it is increased but it is low, then it means that we are going to calculate what we call a credit loss, all right, which we call the loss allowance. All right, so your credit loss or your loss allowance will be equal to 12 months expected credit loss. 12 months expected credit loss. So your loss allowance is equal to what? 12 months. But if it increased significantly, all right, if the credit loss increases significantly, so this one is not insignificant, it has increased very, very hugely, then it means that our loss allowance will be equal to the lifetime expected credit loss. The lifetime expected credit loss. That is that. The lifetime expected credit loss. Now, ladies and gentlemen, what is a credit loss? And what is expected credit loss? What is lifetime expected credit loss? What is 12 months expected credit loss? So first of all, what is a credit loss? A credit loss is simply this. You see, you have invested in an asset, so you're expecting some cash flows. There's some contractual cash flows that are due you, i.e. the interest and the redemption. Okay. So now, what is due you? So we say credit loss is equal to the contractual cash flows due you. All right, due the entity. The entity that is due to the entity, or those ones that entity is entitled to, minus the cash flow the entity expects the entity expects to receive. You see, the thing is that if the thing is not credit impaired, then it means your cash flow that is due you will be equal to your expectation. But since it is impaired, there is a likelihood that what is due you and what you receive is different. So for some of us who have investment like the EcoBank EDC, you realize that what is due you is there, but they say something is called mark-to-market value, and that is what you will be receiving. So the difference is a credit loss. What is due you, which is your interest and your principal, but minus what you actually receive. So you see that what you actually receive, they call it mark-to-market value. Mark-to-market value. That is what you receive. So the difference between those two things is what we call the amount. I mean that so we call it there's a word that they have for it, the actual benefit. But your benefit is supposed to be this, but they call this one then the difference. Now here, what you get when you get the difference, you are going to discount the difference. So this one minus this discounted, you are going to discount it because most of them are in future. Discounted at, please, this is the key, use the original effective rate. The original effective rate. Original effective rate. So don't use any other effective rate other than what? The original effective rate. So that is how you calculate credit loss. Now, if you get your credit loss and the thing was insignificant, you are going to apply, you are going to weight it. You are going to weight it. So you take the percentage of weighting, multiply by what? The credit loss. That is what we call the 12 months. The 12 months expected credit loss. So you know the credit loss, but you expect a percentage of the credit loss. So you calculate the credit loss. So this is it, 12 months expected credit loss. So you'll be given the expectation, the probability. So you multiply. But for the lifetime, it means that they will give you various years, or it is exactly the credit loss because it is over the period. All right, it's not just 12 months out of it, it is over the period. So they can give you, it can be equal to the credit loss, or they can give you the probability of each future year's own. So please, that is what it means. So the most important thing therefore is to be able to calculate your credit loss. So that is that. Now, if the thing is credit impaired, then it means that, and this is where you have to be very, very careful. If the thing is credit impaired, if the asset, so note this down, if the asset is credit impaired, and I've given you the signs of credit impairment already. If it is credit impaired, then it means that your interest income that we calculate, the interest income, the one that we calculate, if it is credit impaired, be very, very careful, because these are the things that make or that can put you into trouble. So if the thing is credit impaired, then it means that your interest income will be on the net. What do I mean by the net? It means you take your gross, which is your balance brought down, all right, minus the 12 months expected credit loss, or minus the lifetime. So minus the credit loss, all right, whether it is 12 months or lifetime. So you deduct it, all right, you deduct it. When you deduct, the interest income will be on the net. But if it is not credit impaired, it means the interest income will still be on the gross. If not if it is, if not credit impaired. Interest income will be on the gross. So, ladies and gentlemen, this is it for impairment of fixed assets. All right. So that is that. That is that. The another thing you're supposed to know is that, for assuming the debt instrument is the one that is through fair value through OCI, then it means that the asset is reported at fair value at reporting date. So any loss allowance, all right, must also go to the OCI. So if it is fair value through OCI, the loss allowance that you calculate, all these things you calculate will also go to where? The OCI. You cannot reduce the carrying amount of the asset. Just as we are talking about here, reduce the carrying amount. You cannot do that. The loss should go to where? The OCI. So let's pick up a question to see how this calculation is done. All right, then we will do the derecognition, then we move. All right. I think we passed through this. Yeah. Okay. Let me see. Okay. So this is where I explain it. Yeah. So let's look at this question. Let's look at this question. All right. So for example, it says that on January, NAPA purchased the bond for 1 million. It is measured at amortized cost. So it means there's a probability of it being impaired. The interest income is 10% payable in arrears. Repayment is due on 31st December 2013. Effective rate is 10%. Okay. So that is that. On 31st December 2011, so this is the year end, NAPA received 100,000. So that's the 10% on the 1 million you receive. It is estimated that the probability of default of the bond within the next 2 months is what? 0.5. So the probability of default has been given. If the default occur in the next 12 months, then NAPA estimated that no further interest will be received and only 50% of the capital will be repaid at the redemption date. The asset credit risk is very low. All right. So what do we see in here? So it means that it says that discuss how you account for this in 2011. Okay, so at the end of 2011, he knows that there is an anticipated impairment. So like the way we used to do provisions, you have to do proper estimation at the what? Reporting date. So be careful, because I told you when I was teaching provisions that provision has effect on IFRS 9. So I told you that. All right, so that is that. So here, the cash flows, there is a hint of credit loss. So you need to calculate the credit loss. So this is what is going to happen. So what is the cash flow due the entity? The cash flow that is due the entity. Of course, we start in 2011 December, 2012, and we have 2013. We are told that the cash flow due the entity, is that he's supposed to receive 100,000 interest, because every year they are supposed to receive 10%. That's the cash flow, all right, not the effective interest. The cash flow is the coupon. Then this year too, they will receive 100,000 because it's 10% per annum in arrears. Then the last year, they are supposed to receive their 1 million plus the interest. If there is a redemption premium too, is supposed to be there. But the question is telling us that the cash flow expected to receive, the expected one to receive, they had, in this year, they collected their 100,000, so they are safe. So it means that shortfall is nil. But it was at the end of this year, they realized that the next one in the 12 months will not be received. So it will not be received. And this 100,000 too will not be received. The only thing they can receive is the 50% on the principal, which is what? 50,000. So what they can only receive is 50,000, half, 500,000, sorry. Half of the capital here. So it means that the shortfall, they will not receive this money. They will also not receive a 600,000. So it means that the shortfall is this. Now we are going to discount this. All right. We are going to discount this using the years. All right. So like you see, this one was already received. So if you are discounting this, it will be what? 1 over 1 plus r raised to the power what? 1. All right. Then this one will be multiplied by 1 plus r raised to the power what? 2. So now what is the rate we use, the effective rate we are supposed to be using for all these things? We are giving 10. So it means what we will be having here is that we will have 100,000 multiplied by 1 over 1.1 raised to the power 1. So that is that. Then here we have 600,000 multiplied by 1 over 1.1 raised to the power 2. All right, so what will you get? And that is what you see here. That is what you see here. It's just that I separated these two. All right, so that is exactly what you see here. And please, this is supposed to be raised to the power 2, not raised to the power 3. If you punch on your calculator, you see that it is actually raised to the power 2. So this one gives you 90,909. Then you have 1.1 raised to the power 2. 1 over that. It gives me 0.826. Then I multiply that one by my 600,000. That gives me 495,867. Or I can call it 868 because it's 0.7 something behind. If I round it up, I'll make this one 8. Then if I add that one to my 90,909, I get 586,777. So that's why I told you that this one, even though you see there's actually an error, 586,776 or 777. So this is what we have as our credit loss. Now this question said is 12 months expected credit loss. So what do we do? What we do is that we will do what is the percentage? It was 0.5%, right? But the question 0.5%. So 12 months is 0.5%. So you have 0.5% multiplied by 586,777. So that answer that I have, I'll multiply at 0.005, right? Because it's 0.5%. And that gives me something around 2934. So this is it. This is what I have. So that's my 12 months expected credit loss. Now watch this. It said that if the thing is credit impaired, our interest income will be calculated on what? The net. If it is not credit impaired, our interest income will be calculated on the gross. Now look at this question. They didn't tell us it is credit impaired. There was no symptoms. Like they just said that there's a probability. So our interest income, therefore, and this is at amortized cost. Okay, this is at amortized cost. So our interest income, don't forget to at amortized cost, we do the what? The balance brought down. So you have balance brought down. Balance brought down is the initial measurement. There is no transaction cost, which tells you that the initial measurement is still the 1 million. All right, so that is that. But the interest income will be calculated on what? On the gross, because it's not credit impaired. So it will be on the 1 million. Our interest income is how much? It's 10% effective. So 10% will be what? 100,000, which will go to our SPL. Of course, they received the 100,000. All right, which means our balance carried down is how much? So this is the receipt. Which means our balance carried down is how much? The same 1 million. But we won't get that 1 million. So this is where the interest, what do we call the credit loss thing coming. So the credit loss, the 12 months expected credit loss, remember, is a financial asset, just like your receivable. What do we do with the bad debt? What do we do? Do you remember? You treat it as an expense. So this figure is what? It will also go to the SPL as what? 29 as expense. All right. It will go to, what is the corresponding entry? The corresponding entry to affect this one, our 1 million. This thing is supposed to be 1 million. So our corresponding income will reduce this 1 million by 2934. So this is it. This is it. So it means that our corresponding entry, double entry. So if we take our 1 million and we deduct this, what is going to our SPL or our balance sheet will now be what? 997066. All right. So this is what is going to our NCA. So be careful. Whenever there is credit impairment, there is an additional line going to, and this one, it is what? Amortized cost. We know amortized cost, we end it here. All right. So be careful. Be careful. So if I didn't mean that this one is measured at OCI, we will do this amortization as we have done. Then we will bring our OCI, our fair value. Assuming the fair value had increased to, let's say, 1.2, then it means that is why we say that the credit loss doesn't affect the balance carried down in terms of it will affect our fair value. So in this case, we will do the comparison here, not this one versus this one. We will do it here so that the massive difference will be going to the OCI. So assuming there was a fair value given us at the end of the year, which we have 997066 minus 1.2, right? That one would have been, how much is going to our OCI? 020934. All right, so that is what would have gone to our OCI. So that is how you do it. Please, this one wasn't credit impaired. So you saw that our income is treated on what? The interest income is treated on the 1 million, on the gross. Has it been that it was credit impaired, then it means we will treat it, instead of treating it on the 1 million, we will first deduct the impairment before we do our interest income. So please be very, very careful about that. All right. Be very, very, very careful about that. All right. So that is that. And these explanations has been done here for you to see. All right. So look at this question. Pen. So here you have this. February 2016 is a 10 to Fen if made a 4-year loan to Fen. So he has a receivable. All right. The coupon rate is 6% and it is same as the effective rate. The interest income is received at the end of each year. On this date, which is like 3 years later, right? Fen tells Eve it's 4 years, just after 3 years. Fen tells Eve that it is a insignificant financial difficulty. So this one is credit impaired. So be careful. It's credit impaired. And at this time, the current market rate is 8%. So you see, you had 6% effective rate. Now it is what, 8%. When you are PVing, what one do you use? Original. So we will still be doing the 6%. If estimated that it will receive no more interest from FEN, and estimate that only 6,000 of the capital will be repaid on redemption date. If I've already recognized a loss allowance of 1,000 in respect of this loan. So they have recorded 1,000. Is the 1,000 correct? Let's find out. So how much were they due to receive? Of course, it's a 4-year, and they are supposed to receive 6% of this 10,000. So 6% of that is how much? 0.06 of 10,000 is like 600. So it means that by the end of January 2017, all right, and let's say January 2018, then January 2019, then lastly January 2020. That's the financial year end period. They are supposed to be receiving interest of 600. It's 4 years. 600, 600. Then here they will be receiving the 10,000 and the 600. So that makes it what? 10,600. And we are told that on February, what is happening this year? They have a financial difficulty. So he says that it is on this date, which means that he has received this money. This one too was received. And it is from the beginning of this to the end of that, it is estimated that, so for the 3 years, it had received. So even in January 2019, it had received. So it was from the February, which is the last year. So here, 0, 0, 0. But here, it is estimated that he will receive no more interest, and it says that also estimated that only 6,000 will be received. So out of all this money, it is only 6, all right, that he will receive. So how much are they losing? So 10,600 minus 600. 6,000, sorry. So it means that for a whooping 4,600, they are not receiving, because it says that you receive no more interest from FEN. And it is also estimated that 6,000 of the capital will be repaid. So it means 4,000 will not be repaid, and the 600 too will not be also be received. So this is the problem. This is the problem. At what point did they see that? It was at this point. So our PVing of this money will be just be what? 1 over 1.1 raised to the power 1. All right. So that is that. That is that. So when we PV it, this one multiplied by 1 over 1.1, that gives me like something around 4181. So if I do, so it's 4,600. So it's 1, you have 1.1 raised to the power 1. Raised to the power 1. So that is that. 1 divided by that, you have 0.099 something. Multiplying it by 4,600, you have what? 4182. So that is what I'm having. 4182. This is credit loss. This is credit loss. That is what has happened. So the question is that, is it 12 months expected credit loss? It's lifetime expected credit loss. So this question made it silent. So, and since it is credit impaired, it is going to be over the period. So now you see that at this point, they recognize only this figure. They recognize only 1,000, which means there is an extra 3,182 they are supposed to recognize in addition. Oh, I've made a mistake. Sorry, guys. Pardon me on that. The discount factor I thought it was 1 point. Original is what? So it's 1.06, right? It's good. We get the correct things done. So it's 1.06 raised to the power 1, not 1.1. It's not 10%. I was still using the 10% we did. So do it again. So we have 1.06, right? So 1 over that, right? Multiply by 4,600. Let's get the correct thing done. So I have here, my answer is actually 4,339.62. So rounding that should be 4340. So that is how it will be. So this is my credit loss. And since it's not a 12 months credit loss, it can be 12 months because it's significant. All right. If it has increased significant, it means what? It is lifetime. So this is lifetime. So what is going to happen? What is going to happen now is that this is the entire credit loss that should have been recognized in the balance, the P&L, but they recorded only what? 1,000. So less what they did, less the one recorded, 1,000. Meaning that they should record an extra what? 3,340. Do you remember in your undergrad or in your SS, we said increase in provision for bad debt is treated as what? An expense. So you see, they recorded this. The increase is also going to the SPL as what? An expense. All right, it's the same thing. But this one, it is credit impaired. So your interest income will be calculated how? Your interest income will be calculated on the net. So here, what do you have? We will have, what is our interest income? The interest income we have in there. So you were giving 8%, and you were giving 6%, and as at that time, the thing had increased to 8%. So what are you going to do? Yes, who can guess? Indeed, yes. Your 6% that you were giving. So it's 6% multiplied by the net. What is the net? So the net, your balance brought down was 10,000, right? Minus the credit loss. How much is the credit loss? We have 4,340. All right. So if you take your 10,000 minus 4,340, it's 556. So multiply by 0.06. So you are getting what? 3. So we have 339.6. So if you want to round it, you can say 340. All right. So that is that. So you see how we work out the impairment. All right. So be very, very careful. All right, about that. Be very, very careful. All right. That is it. Very easy. I think in March 2023 they had a past question like that. Let's see if I have it in here. In March 2023, the past questions. Corporate report in March 2023. Let me see. It's oh no, I don't think I have it here. So look for that paper, or just hold on. Let me find out if you get that paper. All right, so I found the paper. So this is the paper. It says that on December 2022, Hamza purchased, that is a financial asset, 5% bond in Jeans Limited at par. The bonds are repayable in 2025, so last like 3 years. And the effective rate is 8%, all right? So you have the coupon, you have the effective. Hamza business model is to collect the contractual cash flow over the life of the asset. So which one is that? Amortized cost. All right. Then at the 1st December, the bond were considered low risk, so 12 months, low risk, 12 months expected. Okay, so he stated here 12 months expected credit loss. All right, to be 10,000. So they've given it to you. They've given you the 12 months expected credit loss. All right. And on 31st December 2023, however, the James paid the coupon interest. However, at that date, the risk associated with the word deemed increased significantly. So you see, this is again a concept of IAS 37. Initially, they had, at this date, they had it at 10,000. But on this date, it has increased again. So remeasurement of the loss must happen. So the present value, so at that time, it says that the present value of the shortfall for the year ended 2024 were estimated to be this, the present value of the shortfall. I told you the difference between the due you and the amount you expect that is what we call the shortfall. So he has done it for you. The shortfall is done for you. All right. So they've given you the present value, all right, of that too for you. And the default is expected to be 3%. So now you can strike 3% on this value. All right, 3% on this value. So that is what you have. Then on 31st December 2023, it's also anticipated no further coupon payment. You see, it means that even after 2023 too, so it means this one, you are going to do it year on year. It looks as if the examiner, I think there was a day we solved the question about IAS 37. He did the same thing with IFRS 16. So guys, be careful. So, okay, so in November, he did it with IFRS 16. In March, he did it with IAS 37 with IFRS 9. So it means that be careful with that with IFRS 15. Yeah, because it looks as if that is what he's testing. All right, so these questions go on to remeasure. And so it says that 31st December 2025, the only, that is the money they will receive. They will receive no coupon. And during the year 31st December, only a portion of the nominal value of the bond will be. So what portion? A portion. What is that portion? The present value of the bond associated. Okay, so he has given us the present value again. So it means that the present value of the bond was assessed to be this, and with a 5% likelihood of default. So, I mean, get some marks out of this. It says that with reference to IFRS, good. I've told you that anytime the question says with reference to IFRS, he never mentioned the fact that it is IFRS 9. But the moment you know that it is IFRS 9, you have 1 mark. So if this thing is 10 marks, so it says calculate and discuss. So whilst you are calculating, you are discussing. You will get some marks even before you even do the correct calculation. So let me tell you how you earn marks from this. So point one is that the standard applicable, you say the standard applicable are IFRS 9. And you could see there has been remeasurement of financial, the credit loss is being remeasured. And those things are estimates. Loss allowance are estimates. And IAS what? 37 on the loss estimation. That is this. With this one, you've been able to discover you already have 2 marks. So guys, even if you can't do the question, you have 2 marks. Now you come into the IFRS 9 concept. This one, they said that they will hold the bond to maturity. So your ability to also identify that it is amortized cost is also another mark. So classification. So the classification of financial assets is a classification of financial assets. And amortized cost. So if you're able to say this, 1 mark. So if you're able to also know that it is the amortized cost, That one too is 1 mark. So you've not solved the question, but you already have 3 marks to play. So that is what is going to happen. So you see, the question said the treatment as at this 2022 and also what 2023. So that is that. Because in 2022, there was a remeasure of the loss. In 2023 too, you could see that there was a remeasure of the loss. So that is what you are. So that is the applicability of IAS 37. I mean, remeasurement of the estimated loss. So please don't say you can't do it. No, don't ever do that. So now what do we do? What do we do in here? Okay, we look at this thing and we see that, okay, at 31st December 2022, what happened? Okay, so what happened? What do we see here? We see at this date, it's an amortized cost table, so we have to do our amortized cost table. So initial measurement. Initial measurement is on the first day. All right, so this is when they did it, 31st December. So initial measurement, we have 10 million. There is no issue cost. So you have your initial measurement. So you don't have any problem on that. You don't have any problem on that. So you do your subsequent measurement is the amortized cost table. But be careful. This thing, they said it was low. So as at 2022, up to this point, you already know your expected credit loss. They've given it to you. And did they give you the probability for that? They didn't give you any probability for that. It is low. So they said that Hamza, yeah, they've given you and said the bond is low risk and it is 10,000. So that is it. They've done it for you. So as at 2022, our balance brought down is how much? It's 10 million. Wow, this is a 10 marks free of charge. Interest income. This is low risk, so you won't net it. You won't net it. You won't net it. So the interest income is the effective rate. So you see, they calculated everything for you. So effective rate is what? 8%. So 8% of this will be what? Like 800,000. That is that. Payment or receipts. Coupon, 5% on 10 million is what? 500,000. Oh, wow. I love questions like this. But students will be sitting there not knowing what to do. Then at the end of the day, if you add 800, you have 1,008. If you did, so it will be 10,300,000, right? So that is our balance brought down. Balance brought down. So it is what? 10,300,000. But what happens to the credit risk? What happens to the credit risk? So here, what happens to the credit risk is that we are going to do, so we said that the interest income will be on the what? On the gross, because it is not what? It is not credit impaired. So that is what happens. So the income is on the gross. The interest income will be on the gross. So we've done that. But here, what happens is that there is a credit loss. A credit loss of how much? Credit loss of, they gave it to us. What was it? 10,000. 12 months expected credit loss. 10,000. It's as simple as this. What is going to happen to our 10,000? Our 10,000, therefore, is going to our P&L. All right, it's as simple as that. 10,000 is going to our P&L. The same 10,000 is going to reduce. You remember how we did the other one? It is going to reduce the figure that is going to, the corresponding entry is that 10,000 is going to reduce our the carrying amount of the bond. So that is that. What is the carrying amount on the bond? So the carrying amount on the bond is the figure that you have here, 10,300. So please, this is balance carried down, right? Sorry. Here's the balance carried down. It's just like what we did. It's just like what we did. So that's all. It's going to affect it. So because that is the loss allowance, credit loss allowance, 12 months. So like bad debt is this. So what do we do to the bad debt? So here you debit P&L and you credit. So most of the time you are asked to do take it from the principal, like the one that we did. All right, but that principal, remember that when we did that, it was on the interest income here, and this one was the same. So we still had the 10 million. So what is going to happen is that at 31st December, the carrying amount of the bond in the financial statement as at 31st December will be reduced. And please don't make a mistake, because the carrying amount of the bond as at 31st December is this one. This is the one that is going there. This is the one that is going there. So please reduce that by how much? 10,000. That's all. That's the carrying amount of the bond. Don't listen to any other thing. So this one is going to be 10,000. I know that some people will do the 10,000 on this. Please, it's on the carrying amount of the bond. But what is the carrying amount of the bond? Okay, so why in this case, and I'm giving you all the various scenarios, why in this case we will do it on the 10 million is simple, because this is the date we did it. And this 12 months expected credit loss, all right, is in anticipation of the 12 months. That is all. So if the date of this had happened to be the beginning of the year, then, like I said, this is what we do. So the reason why this thing will be on the 10 million, the only reason why it is on the 10 million is because this thing was done at the end of the year, and that is the value, 10 million. So ladies and gentlemen, in this case, our carrying amount as at the end, what we are going to do for this particular bond, in this case, is going to be 10 million, 10 million minus what? 10. So you have 9,900 and what? 90. All right. That is it. That is it. So here, the only thing that happens is this. So that is how you do your amortized cost table. So this amortized cost table, which year do you think this amortized cost table is for? So the initial measurement was at this date. This amortized cost table will be for 2023. That's all. That's all. Because this is the year 2022 where the initial measurement happened. That is when they bought it. And everything is annual. Because they said that the coupon is annual, 10%. So you can't calculate the 10% and be doing all these things when at the same date of the December 20. But if this thing has been first, here will be our December 2022. These are the dynamism you have to understand. So as far as 2022 is concerned, the closing rate, the closing will be what? As we've done here, it will be 9990. That is what happened. And as you are doing this, you are talking about it. Ladies and gentlemen, if you're able to do this amortized cost too, you are supposed to get at least, this is the difficult part. So if you're able to do this one, this initial measurement, you have your 1 mark. If you're able to go on to do this, you get extra 2 marks. So please, we've not even done the 2023. We've not done the 2023 because once we finish doing this, there is a remeasurement for that, which we are going to do. So we have 2, 3 marks, then 5 marks, then what? 5 marks, then Yeah. So we had 3 marks here, 4. So we have 6 marks. So we are just left with the 4 remaining to go, which is what? The remeasurement of the other years. So it says that on 20, there is now a significant risk. There is now a significant risk. So what do you do now? It is no more 12 months. It is now what? A lifetime. So guys, it's just application of the things. If it is a lifetime, we have to calculate it, but they've done it for us. They've done it for us. So as at now, they are trying to tell us that the figure of the lifetime credit loss. So it says the present value of the shortfall. They've done it for us, which is a 462,963. And the probability, I told you, if it is a lifetime and you are given the probabilities, you multiply as such. That's all. So if you are given this one, then it means that the probability is what? 3%, 0.03. So you get your loss. All right. So when you do that, how much are you going to get? Please. And so this one is what? 2024, right? 2024. So you see, we ended 2023. So you'll be bringing the opening balance and you continue the amortized cost table for each respective years as such. So if you do this one, 0.3 multiplied by 0.03 multiplied by 462,963. So it means in 2024, I have something like 13,889 rounded. It's 888.89, but I've rounded it. Okay, so that is that. Then in 2025, what will it be? 2025, what will it be? They also told us that in 2025, so on 2023, it's also estimated that no further, of course, it's true, but they've done it for us. So they've done everything for us. So we don't need to do anything again. We don't need to do anything again. And it says that only a portion, and so in December 2025, so this is 2024. 2025, what happened? Only a portion of the nominal value, but what portion? They didn't tell us. And so they said the present value of the bond was assessed to be this. So this is what we have with the likelihood of what? So it means that the present value, they've done that one too again for us, and the loss too is calculated. So this is it. So all that we need to do is take our 6858710 and multiply by 0.05. You will get the loss on that. Okay, so let me do that. 0.05 multiplied by, I have 6858710. That gives me 342,935.5. So since we've been rounding it, this one will be 342,936. All right, so these are the credit losses. Don't forget, in this respective, we are supposed to do for only 2022 and only 2023. Oh, wow. So it means that even this one, all we need to understand is that with this one, the interest income, we need not to even do it. We need not to even do it. Yeah. Because what is going to happen in this case is that the interest income of 8% would be calculated on, if you take 2024, it will be calculated on what? Do you remember? Yes, the net. And what is the net? The net is going to be the 10 million of the bond minus this. This one too, the same thing. All right. So basically, that is what is going to happen. That is what is going to happen. So you could see that the loss allowance too has increased. Do you see increase in provision for bad debt? Do you remember? The loss allowance we had before was 10%, right? 10,000. It has increased. So you will be recording the incremental. This is 3,889 as the P&L. All right. And when you go here, that one too has increased to this. So you'll be recording the difference. So let's say 13,889 minus 342,936. So that one, the incremental you see is also huge. It's also huge. So this is how it's going to be. So let's say we are doing the amortized cost table. Let's continue from here where we ended. I wish, okay, I can actually drag them. So credit loss, yeah, was 10,000. So let's drag these things out of the way because I need the space to continue. All right, let's just drag them. Oh, let's just drag them out of the way. So our 2024, don't forget, this they are holding to maturity is amortized cost. There is no need for fair value. So here will be 10,300, right? 10,300. Yeah. But the trick in here is that this interest income, don't forget, because there was a significance, we are going to take our 10,300 and we will deduct. Don't forget that. We will deduct. We will have to deduct. So in 2020, what do we call it? In 2024, we sat in 2024 and we actually saw that. So where is it? It is in December 2024, we did all this estimation. So it means that as at December 2024, we've done the estimation to realize that our interest income is changing. So it is going to change. And if it is going to change, then it means that the total, what do you call it? So how much you are supposed to receive minus how much? Oh, please help me. All right. So in 2023, we had this. In 2025, we had this. What is the total? So you could see the incremental. What now is the total? So the total, oh, goodness me, 13,889 plus 34,342,936. So the total gives me 35,6,825. Somebody will 825. Somebody will say, but say, why are you now totaling it again? Yes, we are totaling it again because the cash flow due you. And so they gave you the present value of this, and they gave you the present value of this at the time in 31st December 2024. So you could see that there has been incremental. So for those incrementals, you do know that there has been incremental. All right. So that is that. But you also know well that as you stand in the end of 2023, this is your present value, the total loss. So this is what you're going to do. If you want to calculate your interest income, this you have to take your 10 million and you minus this total, the lifetime expected, because right now it is not 1 year again, it is lifetime. This one was for this year, and this one was for the other years, making it the lifetime. So this one is the lifetime. And if it is lifetime, when you are calculating your interest income, like the example that we did earlier, all right, you will deduct. So this one will be minus 10,300. 10,000, yes. So it means your interest income here will be calculated on 8%. I'm having 8% multiplying the 10,000 minus the total we have downstairs is 9,943,175. So what will be the 8% on that? 8% gives me 79,554. So this is 5, please. Let me do the correct thing. My machine is getting slow. So this one was something like 9943,175, right? So here is 795,454. All right, so that is that. As for the payment, it is an annual payment. This one would be received because they told us that one of them will not be received. That is the end of the year one. So you do this and you get your 2023 balance. All right. So ladies and gentlemen, that is how it works. That is how it works. So just be careful. Just be careful. This is how everything will look for you. So you are going to explain these things, and as you are explaining it, you have to understand. All right, explain it well. Do this in addition. Then the remaining, we were left with remaining 4 marks, right? So you get your remaining 4 marks. So basically, that is it. So apply what you've learned. All right, apply what you've learned. You score your marks. That's all. Ladies and gentlemen, that's it. All right. So now I'm going to end this long, elongated lecture by tackling derecognition. I will just give you the format for it. Then later, if we meet to continue, we will just take some example. But I just need to end everything on financial assets. So that is why. So derecognition, we have selling the financial asset with recourse and without recourse. So sales with recourse, I want to do here. So you are selling it. You are going to the factor. So to sell it, you have to know with recourse and without recourse. So here I will do without recourse. And here what I will do is put in here with recourse. Even the pen is not writing, it is tired. So here with recourse. What is the meaning of with recourse and without recourse? You see, there is a sale you will sell to the factor, and without recourse means that if you sell it to the factor, so you go to the factor, you sell your receivables, he will give you an amount, all right, lower than the fair value. So then the factor will now go out to collect the debt from the customers. So this is the entity, this is the factor, and this is the customers. So you sell to the factor will now go to the customers. So without recourse means that if he goes to the customers and some of the customers doesn't pay, he can't come back to you, the entity. So in that case, what then happens? What happens is that the money that you collect from the factor is cash. You debit your cash. All right. So that is that. And because he can't come back to you, you also don't have any receivables anymore. So you credit your receivables. You credit your receivables because you don't have any more receivable. You have no right to go and collect that money anymore. The only person who has the right is the factor, but you are preparing the books. So assuming that you took your receivable is 1 million and you took 800,000, then it means that there's a 200,000 shortfall, which is a debit. That debit, we call it administrative expense, all right, of 200K. So you also debit administrative expense. So then it balances off. That is what without recourse. But with recourse means that if they go and they don't get the money from the customers, they are coming back to you, which means that the money that you collected, you will debit your cash, all right, but that money that you collected, they can come back for it, which means you have a present obligation. So that one will be what? A liability. And so therefore, your receivables will still be there intact. You won't touch your receivables. It will still be there intact. So ladies and gentlemen, this brings us to the end of the course on financial assets. It's a very, very long video and it's an interesting one. But thank you for staying put to watch, and God bless you.